We all know that this bank crash crisis is going on. We've seen 3 banks now go under. There is another one added to the list. We saw Silvergate, we saw Silicon Valley Bank. Those went under. That was the big talk. And right now, a third one's been added, and that is Signature Bank. They actually went under. The feds came in and took control. Regulators took control, and they're up in the air too, along with all these other banks. So we now have 3 banks collapsing, and SVB is the second biggest one ever. But the Fed has a plan. It says that they're going to protect depositors and that they are going to make sure everybody gets access to their money, but it's not a bailout, and they're not going to do anything with taxpayers, not put on the taxpayers. So the big question for that is, where's the money coming from? You can see their plan right here. The Fed points it out here, saying along with that move, the Federal Reserve also said it's creating a new bank term funding program aimed at safeguarding institutions affected by the market instability of the SVB failure. A joint statement from the various regulators involved said there would be no bailouts and no taxpayer costs associated with any of the new plans. Shareholders and some unsecured creditors will not be protected and will lose all of their investments. So apparently, the plan is to protect depositors and the people who put their money in that bank over the FDIC, right? So 250K FDIC insurance is made up number because now it's infinity, and they're saying that, investors, unsecured creditors, and these guys who invested in this are going to lose all of their money, as they should. They invested in a trash company because the company ended up not working. But now we have the same question: where is the money coming from? They're saying no taxpayers going to get on this. It's not going to be a taxpayer's burden. But then, so where's the money coming from? But their plan for this program is right here, saying the Fed facility will offer loans of up to a year to banks, saving associations, credit unions, and other institutions. Those taking advantage of the facility will be asked to pledge high quality collateral such as treasuries, agency debt, and mortgage-backed securities. It's funny that they say those are high-quality collateral, because those are the things that made SVB have problems and collapse. Because ultimately what SVB did is they had the bonds earlier in 2020, 2021, when rates were really low. They had a huge influx of cash. They deployed it to the bonds. I think they actually have like 10-year bonds. They have mortgage-backed securities when rates were really low, to deploy the capital and get some sort of return on it so that they could make some money. But since then, rates have gone up. The Fed has hiked rates, meaning the value of the bonds that they bought at that time has gone down drastically for bonds. And now they find themselves in the problem here with people wanting to withdraw their money. They're forced to sell the bonds at a deep loss and lock in those losses. So you can see how the problem doesn't resolve itself, because now the Fed says that this loan program's out there. It doesn't solve the problem that was originally there. And it actually probably makes the problem even worse, because you can see here, they say the haircut or reduction in principal issued is critical, as there are estimates to be some $600 billion in unrealized losses that institutions possess in held to maturity treasuries and mortgage-backed securities. So that's what the whole kind of problem is, right? When a lot of these guys had a ton of money in 2020, 2021, they deployed it into long-term treasuries and mortgage-backed securities when rates were still low. Now rates are going up, so the mortgage-backed securities they hold go down in value because they're lower interest rates. The bonds that they hold go down in value because they're lower interest rates. Why would someone pay a premium for a bond paying 1% when they can go right now and buy a bond paying 4 or 5%? And you can see Dylan LeClaire here breaks it down pretty simply, saying the Fed's newest credit facilities allow banks to borrow against their long duration bonds at par despite the historic drawdown. So basically, the plan is this $600 billion in losses that people are sitting, unrealized losses that people are sitting on. This is a systemic risk. The Fed is saying that because they introduced this whole thing. So a lot of banks are sitting on $600 billion in losses. And if people withdraw their money, they're going to have to lock in those losses. You run the collapse of the banks. But here, now their new system is just pretend the losses don't exist. Just go ahead to the Fed, say, I bought this bond for $10. It's only worth $3 now, or it's only worth $6 now. I want to borrow money and they will come and say, we'll give you $9 that you can borrow against that bond, because they have like 10% haircut and stuff. But they will give you the $9 for the bond that you bought at $10 that's only worth $6 now. You see how this whole thing just doesn't make any sense? It doesn't solve any problems. Maybe short term it solves, hopefully, stopping a bank run or a bank collapse and bank crisis, but it doesn't solve the problem that led us here, that these banks put themselves in, that the rate hikes put everybody in. The rate hikes are breaking things now. It doesn't solve any of those problems. Puts a band-aid on it. And you can actually see their term sheet stuff. They're kind of this new program that they're putting out. You can see this whole thing, breaking it down here. They tell you everything, how you can be eligible, collateral that you can be eligible. And we can see this kind of breakdown easier here, saying lots of interesting details in the term sheet that weren't publicly disclosed in the press release. Is foreign banks are eligible, all collateral valued at par, 0 haircuts, no fees, no prepayment penalty, $25 billion exchange stabilization fund backstop, which again is crazy, right? It's them saying they're going to give you collateral at par. They're going to give you 90% of this collateral at par, so no loss. So all these banks who have $600 billion in losses right now can go to the Fed and say, hey, I don't want these losses. And they'll just give you the money. And now instead of a 40% loss, now you're taking a 10%, because it's 90-10. You can get 90% of the loan out of those assets. So it is not solving any problems. It's probably making things a lot worse. If you're a bank, this whole thing, why would you take risk management? Why don't you just go way out on the risk curve? Just take riskiest investments, because if they pay off, you make a bunch of money. And if they don't pay off, the Fed's going to buy them from you for whatever you paid for them, so you don't lose anything. This whole move, it all screams just socialized losses and privatized gains, which is a insanely dumb system, right? You can't let people go out and lose all of their money and say, it's okay, we'll give you your money back. And then when they make all of their money, it's theirs to keep when they had the risk. When you take the risk, if you lose the money, you lose the money. If you have a business and you take this risk and you lose money, you shouldn't be able to go to the Fed and tell them, buy my assets for what I paid for them so I don't lose any money. That doesn't make any sense. But the whole thing they're trying to avoid, right, is another repeat of 08, another financial crisis. They say that the scenario harkened back to 08 collapse of investment bank giant Lehman Brothers, which also found itself insolvent and in search of a buyer. The government was also unsuccessful in that case following a weekend of wrangling, triggering the worst global financial crisis. So they're probably trying to avoid that. I mean, they're definitely trying to avoid that, right? Nobody wants a repeat of that. But this is a temporary solution that doesn't solve the real problem. And ultimately, if the Fed or the FDIC is trying to sell off this bank, SVB, and no one's willing to buy it, because that's probably what's happening, right? They're not getting any bids. They're saying, we'll take anybody to buy this bank, and they're not getting any bids for it. So that may say to them that these banks, even the big banks, they don't have any money. They can't buy this bank because they don't have the money to buy it. And that's a big problem, because if they don't have the money to do this, then they probably don't have the money to honor withdrawals if a bank run was to happen on other banks. So ultimately, this plan doesn't solve any real problems. Maybe it's a short-term solution, put a band-aid on the problem, but ultimately it will continue to be a problem in the future. I don't think they really care about that. They just kick the can down the road every single time, because why would you want to solve a problem? But that's going to do it for this video. As always, don't forget to smash the like button and subscribe, and I'll see you guys in my next video.